Kitco Mining's special coverage of the Precious Metals Summit is brought to you by Nucor Gold.
Are junior stocks going to have their day in the sun? I am Paul Harris for Kitco Mining at the 2024 Precious Metals Summit in Beaver Creek, Colorado. To help me answer this question today is Rick Rule, President and CEO of Rule Investment Media. Rick, welcome back to Kitco.
Pleasure, Paul. Thank you for having me back.
We've just been sat outside in the sun having lunch, and we spoke about a lot of things. But let's cut to the chase. We're at an investment conference. You're an investor. What are you looking for?
Well, the name of my talk this afternoon is Open for Business, where I'm talking about the fact that I'm an active check writer in an environment like this. The fact that we've seen reasonable moves in commodity prices, both precious metals and industrial materials, without a concomitant move in the equities, tells me that the equity markets, from the point of view of a speculator, a patient speculator, that this is a good time to be deploying. And I guess that's what I'm doing here. There's probably 200 issuers here. It's a wonderful opportunity for me to meet 50 or 60 people without having to log 50,000 plane miles.
Now, rising high metal prices, rising tide floats all boats, but obviously you're more discerning than that. What are some of your golden rules for filtering the companies you invest in?
Well, Paul, I'll tell you, it doesn't float all boats because most of the juniors don't have any metal. They're looking for them. In my career, so many investors have said to me, back in the days when I was a broker, as an example, if the gold price goes up, how will that impact the shares of, Amalgamated Moose Pasture Gold Mines? And I try to say as gently as I can, if the price of something that you don't have any of goes up, it shouldn't really impact your fortunes too much. So it's important to differentiate that too. I think it's important as well in the junior sector to understand that most of the juniors are subscale. Most of them are so small that general and administrative expense consumes most of the capital they raise. Those companies are doomed to fail. We've talked about this before, Paul, but I suspect that 3/4 of the juniors that are public worldwide, Australia, Canada, the United States, Great Britain, are valueless, absolutely valueless. That disguises the fact that maybe 5% of the issuers generate so much performance that they add legitimacy to a sector where 75% of the listings are valueless. What I'm doing, of course, is looking for that 5%. If you start with a group that self-selects to be at a conference like Beaver Creek, and you try and find the best 25% of 200 who are probably already in the best half of the issuers, it's a target-rich environment for a speculator like myself.
When you start that process, Rick, do you focus on the geology? Do you focus on the balance sheet, their G&A burn, their cash?
All of the above. I'm 71 years of age, so one advantage that I have is that I have a very deep, now called contact file. It was called Rolodex when I was your age. And one of the things that I'm looking for are familiar people who have been successful before in a task very similar to the task at hand. Or I'm looking for a strategic investment by somebody who I have co-invested with in the past. So for me, I guess it starts with people.
So it's the power of networks.
Yeah, I mean, I want somebody to be a demonstrated success, and I want their prior success to be applicable to the task at hand. Someone comes to me and he says, well, I was successful. I operated a gold mine in Archean terrain in French-speaking Quebec, but the task at hand is exploring rather than operating for copper gold in tertiary volcanics in the Peruvian Altiplano, Spanish-speaking. The success isn't necessarily germane to the task at hand. So I want specific success germane to the task at hand. And for me, everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can never make you big money. So I do want scale. I care a lot about the property. And I care about having in situ value of at least inferred being at the sort of $2.5 to $3 billion US range, preferably bigger than that. So I look for that. I would say my competitive advantage here at Beaver Creek is I'm much more agnostic to perceived political risk than most of my competition. Many of my competition won't go outside Ontario and Quebec. And for me, I'd much rather take perceived political risk than I would technical risk. I want a good project before I care about the jurisdiction.
Now, the power of networks makes a lot of sense, but there is new blood in the industry. There's been some good leaders emerging, and I'm thinking of Chris Taylor, Brandon McDonald, Scott Birdall. Yep. How does new blood get onto your list?
Easily. It's introduced to me by old blood. I learned about Snowline from Ross Beatty. I've invested with Ross Beatty for 35 years. He said, there's a young team that have a project that's really attracted my attention, and they ought to get on your radar screen. That's really important to me. You know, the investment banks, bless them, have an agenda. If they don't do a transaction, they don't earn a fee. My old contacts, people I co-invest with, have no agenda. So I would much rather get a referral from an investor than I would a broker.
Now, one of the things we were talking about why we were sat outside sunning ourselves was the fact that almost all of the companies in the sector don't communicate well. What is it they're doing wrong, or what is it they're not doing? What is it they should be doing better?
Well, I think the first thing is that they don't target their audience well. A lot of companies believe that the investment banks are responsible for their capital acquisition strategy, which is wrong. They are responsible for their capital acquisition strategy. And I think that in the same way that a company needs to have a business plan with regards to the deployment of capital, that they need to have a business plan around the acquisition of capital. Who is the target audience? Why are they your target audience? What does that audience care about? How can you address that audience's concern? Many issuers, probably 80% of the issuers that I talk to, aren't familiar with my work at all. They don't know how to talk to me. I remember very early on when I first met Robert Friedland, to me the dean of all promoters. Robert knew enough about me that his pitch to me was tailored to my own bias. I'm not suggesting that every company can do that, but I am suggesting that an early stage exploration company, as an example, needs to tailor their audience either to the corporate development team at a major mining company, a strategic investor, or a professional investor or high net worth retail. They're not going to be able to, in this kind of market, interest low-end retail, and they're not going to be able to interest most of the institutional investors. So understanding who the logical target is, and then understanding how to access that target and address that target is critical. But for many companies, there's a failure to even try. Paul, as you know, I've put on a conference now for 28 years. And for some years, I'd wander through my own exhibit hall and I'd take a picture of empty booths. It's very difficult for a company to interface with a customer if the company doesn't show up to interface with the company. I ask companies today about their social media strategy. If they don't have one, that's the end of the discussion. When I was coming up, to access an audience, you either had to have a way through an industry publication like the Mining Journal or an investment publication like the Wall Street Journal. But those barriers are all gone. You can access the whole world through social media if you know how. The social media guys aren't going to come to you. You have to come to them. In other words, if somebody doesn't tell me I'm going to go hustle Paul Harris, what they're saying is that capital acquisition doesn't matter to them. And their capital acquisition strategy matters a lot to me. That's their cost of capital.
Sounds like a lot of companies aren't necessarily very good at marketing or don't understand.
They don't understand it. I mean, they understand the importance of it, but they haven't thought through how to do it. My biggest complaint is that they consign responsibility for shareholder development and cost of capital to the investment banks, which is wrong. A week after your deal closes, the investment banks are on to the next deal, often even selling your shares out to fund the next fee-generating transaction. As a CEO, as an IR person for a company, you're responsible. The investment banks aren't responsible.
Absolutely. Now, gold is at $2,500 per ounce. Some gold stocks are up 100% year to date. But I imagine the critical question for many of the delegates here is, are junior stocks on the verge of a rebound? Are we getting close to a tipping point?
I think the answer to that is yes, and I think that's unfortunate. I think that most of the junior stocks are valueless at any gold price. But I do think, irrespective of that, that we're going to start seeing capital return to the sector because of the successes. The recently announced takeover is an example of sentiment, not a junior, but those takeovers add both hope and liquidity to the sector. And those are both very, very, very important circumstances. And so I do think that you're going to see a return to positive sentiment in the sector. I hope that that response isn't too frothy. I hope that investors don't throw caution to the wind the way they sort of seem to in 2020 as an example. But in direct answer to the question, I do think that the purses will be loosened.
Well, you mentioned the AngloGold Ashanti sentiment deal, so let's talk a little bit about M&A. That was a cash and stock deal, I think $1.9 billion. A week or two ago, we had another big ticket M&A transaction with Goldfields buying Osisko Mining, an all cash deal there. So the Osisko Group has been investing in developing companies for a number of years. So presumably some of that capital will get recycled back into the exploration stroke development sector. Do you anticipate more deals coming through of that sort of magnitude?
I hope so. It makes perfect sense. Capital markets have evolved to the point where passive investors are an extremely important part of the market. Larger, more liquid companies benefit from more passive buying, more index buying. And so companies whose focus is amalgamation, Equinox Gold, Caliber, people like that, there's a natural place for them in the market. Bigger companies, more trading liquidity, lower cost of capital, will be able to buy companies, amalgamate with companies that haven't done that, and will be able to automatically lower their cost of capital. Single asset producers are viewed as riskier than multiple asset producers. You eliminate that discount immediately with a takeover. Sentiment, there can't be a single asset bias against sentiment when it's part of AngloGold. And so those are two absolutely natural circumstances. And as long as capital remains constrained in the equity markets, I think M&A continues to increase. Now, ironically, the increase in activity in M&A probably loosens the purse strings in the equity market. It might be a self-correcting phenomenon over time, but I suspect for the next 6 months, that it's going to be M&A heaven.
Let's look into that a little bit deeper. Gold price at $2,500 per ounce. It's moved from $2,000 to $2,500 in a relatively short space of time. One of the key conversations in any transaction is the relative valuation of the parties. The gold price going up $500, relatively short time. Company A's share price might have gone up 10%, Company B's 30%. So you've got a disparity that has to be resolved if a transaction's going to proceed. Will the gold price affect the ability of M&A to occur?
The availability of capital will impair M&A over time. Understand survivorship bias. You have two entrepreneurs who've built two companies. Both of those people want to be the survivor, and only one can be a survivor. Most of the deals that I've seen that haven't taken place not because the benefits to shareholders of the acquired company weren't sufficient, but rather because the benefit to the management wasn't sufficient. So you have to overcome survivorship bias. I think that's probably more important. I don't think it should be, but that's a different question. I think it's probably more important than the metals price. If companies have the ability to access capital on terms that they consider to be reasonably attractive, they have no incentive to participate in a merger. So I think it's important that you understand management incentive in the context of G&A. There will be situations where the attractiveness of the transaction is so apparent and there's so much room in the valuation that the team that doesn't survive can be compensated because the acquisition is so appealing. An example would be the recent acquisition of Reunion by G Mining. Both management teams knew each other for a very long time. The G Mining people did a wonderful job of discovering the deposit, advancing the deposit. But now came the hard part, the mine building team. They knew the Gignac family for 30 years. The Gignac family have experience in mine building in tropical high rainfall environments. It was a perfect merger.
And just this week, they put out a PEA, a preliminary economic assessment on Oko West. So that looks like it's going to go forward. Are there any, who would you say are the prime candidates for M&A? Which are the deals that, are crying out to be made if everything else being equal?
Well, since we're in Guyana, the other part of the Oko West deposit
G2 Goldfields.
is G2. Yeah. And the G2 guys, high quality people, high quality deposit. If it isn't one deposit, it's certainly one mineralized event. So the most obvious thing that I can see out there is obviously G2 into something involving their next door neighbor. Obviously, Goldfields would like to play a role in that somehow. There's a blocking stake, which is very smart by G2. They've introduced some dynamic tension. But I think that needs to happen. As a G mining shareholder and as a Lundin Gold shareholder, I would love ultimately to see Lundin Gold take on all of G2, Reunion, and G mining. Again, because the Lundin family has done business with the Gignac family for 20 years. There's no cultural impediment to a merger. And so that seems to me to be something that could work in the longer term.
Well, G Mining built the Fruta del Norte mine of Lundin Gold.
And they did a superb job. And the CEO of Lundin Gold, Ron Hochstein, was instrumental in securing the Lundin family investment in G Mining. So there's
history.
Yeah, there's a lot of history, and there's a lot of potential for synergy. That, and I'm not trying to say that I have any information that it might occur, but if we're allowing ourselves to fantasize, you take Lundin Gold in that circumstance, or whatever the resulting company would be, to two tier one deposits with global production in excess of 1 million ounces, in the bottom cost quartile worldwide, in the highest return on capital employed worldwide. It would be a very formidable company.
Lundin Gold's in a very interesting position at the moment. It's a single asset gold producer. Yep. It's just cleared all its debt. It's one of the lowest cost gold producers. So the free cash flow is incredible. It's just increased its dividend, but it still has that single asset risk. Yep. It has the country risk aspect with Ecuador. Diversifying would be a good thing for it. But with such a high-grade asset, where does it turn?
Well, I think it'll be, as you would suggest at the beginning of the discussion, is it accretive for Lundin or is it not? There you have a CEO who is very aligned with shareholders, because in this particular case, the shareholders have their name on the door. And Ron Hochstein, superb guy, has worked with the Lundin family for 25 years. He's an absolute loyalty to shareholders, which is not ubiquitous in the mining business. So a transaction is an example that, and I'm speculating again, saw Hochstein elevated to chairman and some other younger management team, say G Mining, fulfilling more of the management roles. And people shouldn't read anything into this discussion. We're having an educational
speculating,
discussion.
Yeah.
But it's that type of deeper dive into strategy that's involved in M&A arbitrage. And there wouldn't be objections to a transaction, I don't think. And if you had a sponsor like the Lundins that are very large shareholders and would have the ability in an amalgamation announcement, if more capital was required, to write a lead order, those are all things that contribute to successful mergers. I think if you go back further with Centamin, when Endeavour tried to take them over, I think you had a very clear case of survivor bias. Endeavour had just done a deal with Semifo, so they weren't prepared to push probably as hard as they would have had to push with Centamin. But I think you saw the real objection there being the Centamin people wanted to be the surviving managers. I think that's what got in the way of that transaction. And my suspicion is that the institutional investors at Centamin forced this last transaction.
I think sometimes this can produce some very interesting results. I'm thinking back a couple of years to Kirkland Lake Gold, yes, when they saw the moment to expand and they bought Detour Gold. So they come from a very high grade asset base to a low grade disseminated. The market instantly hated that. In the moment, it hated that, but that's proven to be a very, very good acquisition.
It was a great acquisition. I think the problem that you had there is that the market was speculating that somebody was going to take over Kirkland. And the shareholders that populated the Kirkland shareholder base hadn't anticipated that they were the acquirer. They were looking to receive rather than pay the premium. Now, for me, that was very useful because I was able to be in the backside of that trade. That was lovely. When you have a whole bunch of people that are exiting a trade for reasons of their own preference rather than arithmetic, that's a great place to be a speculator.
Okay, now let's wrap things up, Rick. How do you think the rest of the year will play out in the gold space?
I think there will be some continued disappointments in the sense that investors look at the increased gold price and they think that producing company margins should expand very rapidly without understanding that the input costs have also escalated. Energy costs have moderated, which is a good thing. But the social take, which is to say taxes, royalties, off-concession expenses, things like that, are increasing, I understand, at about 15% compounded. Labor costs are going up. The price of spares is going up. Finished steel is going up. And I think there will be continued disappointment among investors about the fact that the margins, the producing margins, aren't increasing as fast as one would hope, given the increase in gold price. So I think that it's going to be a positive environment, but it's going to be tempered for the balance of 2024. My suspicion is in 2025, all other things being equal, it's going to be a pretty good year.
Well, let's hope so. Rick Rule, thank you very much for joining us today.
Pleasure, Paul. Thanks for the opportunity.
I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of the Precious Metals Summit is brought to you by New Core Gold.